Well, we'll see the Fed raise the Fed funds rate next Wednesday by a quarter of a percentage point, and then they'll continue to raise it throughout 2022 in an effort to cool off growth and curb inflation. They're going to be gradual, they're going to be steady, but certainly I think the risks are to the upside with the Fed funds rate. If inflation stays higher because of high energy prices, then the Fed will need to raise more aggressively.
Gus, let me pick up on that point about how aggressively the Fed needs to tighten, because I think what we're trying to illustrate with the data coming in here is there's so much going on between the actual inflation readings, the psychology that's now building up, that they have to be really careful. I think Stephanie Link put it really well last hour when she said, even if they hike 5 or 7 times this year, that's not going to solve the inflation problem.
Well, no, not in and of itself, but we are going to get slower inflation because of things like eventually the crisis in Ukraine will come to an end and we'll start to see energy prices decline again. Part of the thing that's boosting measured inflation now is comparisons with early 2021 when prices were low coming out of the pandemic. That's going to fade from the data. So it's going to be a combination of Fed tightening, a gradual resumption of normal activity with the presumably some sort of stall in the Ukraine-Russia conflict, and then the Fed raising rates in an effort to cool off growth. In between all of those factors, we should see substantially lower inflation at the end of this year and then again in 2023.
Sure, no one's saying we're going to still be at 7%, but even if we're at 3 or 4% at the end of this year, if we're at 3 or 4% well into next year, which is what the wages and everything is kind of pointing to, that's still a problem, isn't it?
Not if inflation is slowing. I mean, I don't think we should expect that inflation is going to fall from 8% in early 2022 to 2% by the end of this year. I think that's a recipe for disaster. But I think if inflation is heading in the right direction, if we see energy prices starting to come down, if we see some of that tightness in the labor market dissipating somewhat, then the Fed is moving in the right direction. And I'm pretty confident that the Fed has the tools to get inflation to 2%. It may take a couple of years, but I think that the Fed knows what they're doing. They have the tools to do so.
So you basically don't think it's that big of a deal if inflation is in the 3 to 4% range for a couple more years?
I wouldn't say a couple more years. If it's 3 or 4% at the end of 2023, I'm a little bit more concerned. But if it's at 3 or 4% at the end of this year and slowing and going to move lower in 2023, then I think that's okay. I mean, don't forget we had a period coming out of the last recession where we had inflation well below 2%. So I think the Fed knows what they're doing, and they don't want to cool off inflation too quickly because that can push the economy into recession.
Final comment, what is your GDP outlook at this point with everything that the economy is now dealing with in terms of supply chain and cost spikes?
We'll see real GDP growth this year of between 2.5% and 3%. That's a good, solid number. That's above the economy's long-term average. And then we will see slower growth in 2023 as some of that Fed tightening starts to bite on growth a little bit more. But I think we will see a gradual slowing in growth this year towards a more sustainable long-run pace.
All right. So you're telling everything's going to be fine. No one needs, the Fed needs to just chill. Investors need to chill. Growth is going to be fine. Inflation's going to be fine. I hope you're right.
It's going to be bumpy, but I think the Fed knows what they're doing.